Welcome to another Ask Our Expert series. For those of you who don't know me, my name is Alethia O'Hara Stephenson, President and founder of the Dufferin County Canadian Black Association. And this organization was established to advocate for, lead, educate, and advance the needs of the Black communities in Dufferin County. On tonight's meeting, I have my board members with me, Ian and Jordan. So it's an honor to have their support always. So thank you very much for coming out. So without further delay, I will introduce our guest speaker or expert for tonight. She is a trailblazer in her own right. She is a mom. That title alone should say it all because moms do it all. She's a mom. She is a marketplace minister and a mortgage broker, author, and a legacy coach. She is also, she was also recognized as one of the 150 Her Story in Black women who have made a place in Canadian history featured on CBC. Her name is Siobhan Bent. Siobhan is the mother of a young boy, and having the need to establish a legacy for her own family, she went on and paving a pathway of developing her mortgage business. And that was a way for her to secure a legacy and generational wealth within her own family and, of course, within the Black community. Siobhan took the leap of faith at the age of 23 and purchased her first property. And then after purchasing her first property, she got hooked, fell in love with the industry and ventured on her own and established her own business. So without further delay, please welcome Siobhan, and she will do tonight's presentation. And if you have any questions, as I mentioned before, please save them until the end of her presentation. So welcome, Siobhan. It's an honor to have you. Thank you for joining us.
Hello. Good evening, everyone. Thank you so much for the invitation, Alethia. I'm truly honored to be able to serve your community today. As you mentioned, I am very passionate about educating our community about, how they can leverage real estate to create wealth. As I said, I made my first purchase over 20 years ago, and we've never looked back. So thank you. I am honored to be here. So I will go ahead and share my screen. All right, can everyone see that? Please drop a 1 in the chat if you can see that. Okay, awesome. So welcome to Homeownership Made Easy. I try my best in my practice to simplify the process. And so Homeownership Made Easy, once people have, I feel, even the foundational information, they can make the right decisions in order to take that next step, right? When I purchased my property years ago, I had the honor of working with a mortgage broker at the time. And so that experience is truly what led me into the industry, because I know once the information is provided with somebody who's knowledgeable and is looking out for your best interest, the process, which can be overwhelming, makes it seem much more easier than it actually is. So welcome to Homeownership Made Easy. And so for everyone here, congratulations. I do really honor people who take the time to educate themselves on making life-changing decisions. Real estate industry is not something simple. So as much information as you can gather, the better it is for you and your family. So I do congratulate you. And so Alethia already shared my bio, but this is my little son. He is almost 9 years old, almost at 8. He surely corrects me. Mateo, as I said, I've been in the industry for over 20 years, and my real reason for getting into the industry was because of my own personal upbringing. I'm the eldest of 3 children, raised by a single mom. We grew up in community housing, and I had firsthand knowledge of how difficult it was to take care of your household and to create and plan for your future. And so when I decided to enter into the industry as a homeowner first, I knew that that was going to be the way that I shifted the trajectory of my family legacy. And so once I had my son, I was already on the path, but of course, you now have children. It's not about you anymore. Again, as Alethia shared, it evolved into my business. And so I've created a community called Mortgages for Moms. And in this community, I basically share the tools and the resources that, a mom would need that, isn't readily available out there for the mom community. And so with the information, they're able to make sound decisions and start the journey early, like I did when I was younger. And so today's talk, as I mentioned, homeownership made easy. And my intention here is to provide you with the information that you need to begin your journey to homeownership today, right? With just we're going to be really general information, but in just knowing where to start, you can make a decision that this is something that you want to do. And so what do I do as a broker, right? Many people don't really understand what a broker does. And on the next slide, I'll kind of differentiate the difference. But I work for the client. I'm not tied to any one institution. I represent you as a client, right? I'm making sure that whatever product that you are looking for, it's specific to your family needs, because mortgages are not one size fits all. Right? So if you walk into a lender based on what they can offer you, if it doesn't fit you, they cannot help you. Right? And so I have access to a wide range of different types of lenders and institutions that may have a product or program that can fit your particular needs. So when you're working with me, you're not only getting a friend, but you have access to options that will make it much easier for you to attain home ownership. And so another bonus with working with me is that with brokers, we build relationships, right? So whether you are ready right now or you may be ready in 5 years, I can still work with you to get you ready to get to where you need to go. When you go through a traditional lender, it's either you're ready now or they can't help you, all right? And so I help clients with purchases as first-time owners, repeat buyers, investors. There's people who, still live at home with their parents, but still want to tap into the market. So I can help you as well too, right? And so the main difference between the banks and myself as a mortgage broker is kind of in this image here. The bank, when you go to the blue one, the red one, or the green one, they can only offer you what they offer through that institution. And so when you're working with me, as I mentioned earlier, I have access to all types of different lenders, trust companies, private lending, broker lending. So you have a slew of options. So where you can't fit with one institution, we can more than likely get you in another institution, right? And so if you're ready to get started, having options puts you in the best position to start your journey. All right, so why real estate? There's actual power in real estate. And, I'm a little biased, of course, because as I said, I experienced what the power of real estate could do early on in my I would say career, my life. I was 23 when I made my first purchase, and all I had was $5,000. $5,000 can't do much right now. Yes, I know. But $5,000 got me into a condo in Toronto, right? And in just a few short years, my $5,000 turned into over $40,000. And so I was sold. Nobody had to tell me anything else. I was sold and knew that this was going to be the way that I was going to make my money work for me, right? So when you invest in real estate, that's exactly what your money does. You're paying yourself on a monthly basis. So your money is invested into something that is also going to grow and allow your money to grow for you while you're living there, right? It's actually the most secure way to invest. There's many different ways that you can invest your money and allow it to grow. But in real estate, you actually have something tangible, right? It's not a statement. It's not, online or an app. You actually have physical property to see where your money is being invested into, right? And so investing in real estate also creates a habit, right? Many people have difficulty saving. But when you invest in real estate, you're typically forced to save your own money because you're paying yourself every single month, right? And it's also a leveraging tool. When you invest in real estate, you're paying yourself, you're paying down your debt, but you're also leveraging the power of appreciation. So real estate, as you know, once you wherever you put your money in it, the market is going to dictate how quickly your money grows, but it will grow, especially in our market. And so for many people who aren't a homeowner yet or haven't been exposed to the industry, I like to lay out, apples to apples, right? And so what's the difference between renting and homeownership? And I don't want to say that everybody is equipped for homeownership. I understand that not everybody is, but I do believe that everyone can figure out a way to invest in real estate, even if it's not for them to live in, right? So when you rent, you're investing in someone else's wealth, your landlord, the building management, whomever it is. But when you're investing in real estate, you're investing into your own wealth, right? And so as I said on the last slide, by paying your mortgage every month, you are paying yourself first. And so when we use our money, we should be using it not only for today, but also for the future, right? As a renter, your money would finish quickly. Let's say as I said, I had $5,000 when I got into the industry. And if I had rented, once that $5,000 was gone, it was gone, versus me investing it into the real estate and allowing it to grow in my property. So my appreciation was going up. There's restrictions. When you live somewhere, you want to be comfortable. You don't want to be restricted with what you can do to the property. Yes, you can paint it but there's sometimes when you're living in someone's home, there's very little that you can do to make yourself comfortable. So when you have your own property, you have the freedom to make yourself make yourself comfortable, whether it's for short term or for long term. And so now there's different ways to invest in real estate. Most time when people hear buying real estate, they think about, living in it. And yes, that's the number one way to do that, right? You buy it for yourself to live in, which would be considered your principal home. But there's other ways that you can live in, or you can invest in real estate without actually living in there, right? As I said, I help a lot of young people who may not necessarily be ready to leave their parents' home, but they have the means where they can invest in property, and then they will rent it out, have someone else live in the property and pay down the mortgage and allow their money to grow. So that's considered buying and holding. If you're savvy and have access to, construction or contractors that can do construction, buying real estate to flip it. So you invest in a property that you're going to keep for a short term, do a little bit of upgrades, and then sell it and then make your profit, right? And you can do that as many times as your money will allow you to do that in the industry. Joint ventures. This is something that in our community is not talked about a lot. And when it is, it's shut down pretty quickly. But as you know, is living in GTA or anywhere the surrounding areas, prices are not very cheap, so to speak, right? And so by partnering with people, and it is a way to get you into the industry a lot sooner than you would be able to if you were trying to save on your own, all right? And so by going in jointly, you can figure out what that split could be. It could be 50-50, it could be 90-10, however that looks. But you would then, invest, whether you're buying and holding it or flipping it, and then share the profits, right? Any which way you decide to go in, your money is going to work for you, all right? You've got pre-construction properties. So there's resale. So somebody already lives in a home and you've decided you wanted to buy it. Or it's you're buying the blueprint, it hasn't been built yet. This is a way that many people get into the industry when their plan is more of a long term. They're not ready to move in yet, but they have the money to start putting down their down payment until it's ready. Pre-construction can take sometimes, a year to even, I've seen up to 3 years to be completed. So that gives you time to save more money, but it also allows your money to grow a lot faster. When you buy your property on paper and between when it's completed, like your property has already appreciated in some cases as much as $100,000, right? And so that's also a way that you can invest in real estate. And private lending. Some people just don't want to do the property part. You can connect with, real estate agents or mortgage broker myself. And there's people who would need access to private financing because they can't access money through the traditional lenders. And that's also a way that you can invest in real estate and have your money work for you. So the process. It's a long process, but again, when you're working with a mortgage broker, they are walking you through the process. And so because of time, we're just going to skim through the first step, right? And so you want to discuss your home ownership goals, knowing why you're purchasing real estate. I can tell you, it's the greatest thing. Your money's going to grow. You can earn this much. But if it doesn't align with what your actual goals are, it's irrelevant what I have to say. So you got to know what exactly your investment goals are. Are you planning to live there? Is it going to be short term? Do you, if you have children, are you planning for your children to live in the property? You might want to buy out of province or something. Whatever your goals are, you got to define them both short term and long term before you make the step. Assessing your budget. The numbers matter, and we're going to get into that a little bit later. But again, in the GTA, things aren't cheap. Like my property I purchased for $100,000. You definitely can't get that anywhere around here, right? So you got to know your budget, because when you are investing, yes, it's a great idea to do it, but if you can't afford it to carry it, then we have to reassess. So knowing the numbers upfront is vital. Assets and liabilities. Investing in real estate is really one of the pillars in creating generational wealth or even retirement wealth, right? So we got to know where you are today and see how homeownership can fit into the long-term model as well. Review your needs, and I put that in bold, then your wants. I have clients who, they have a few children, and ideally you want to have a home that can fit each child having their own room. But sometimes the budget and what your needs aren't in alignment. I have a motto that I say to my clients: get in where you fit in. Get in where you fit in. Your first home doesn't have to be your dream home. Your first home does not have to be the ideal home, but your first investment should be something that you put your money into so that it can propel you to ultimately buy a property that can accommodate all of your wants in addition to your needs, right? So knowing what you need first, then coupled with your wants, and then you can create the plan. And so obviously by assessing all of this, we're creating your blueprint for your journey in homeownership or investing. So again, know your numbers. The numbers. I'll probably say this a few times, the numbers. All right. Affordability is key. Right? Yes, I want to help you get your mortgage. Yes, I'm sure a real estate agent wants to sell you a property, or a builder wants to sell you a property. But if the numbers don't make sense, the numbers just don't make sense. You don't want to go in over your head. And so knowing your numbers first looks like getting yourself pre-approved. And so what this will do, it'll avoid any hiccups or obstacles before you begin the process. So whether you're a first-time homeowner or your second repeat buyer, homeownership or investing is kind of an emotional purchase, right? And so if you have full information up front before you going out, you won't be disappointed, right? Now, I don't think there's a realtor that I know that will take you out before you actually have some form of conversation with a mortgage professional or your bank, because they don't want to be, hurt. They don't want to waste their time. So we got to know the numbers first, right? And so what that does, it also gives you clear, concise numbers. You know exactly what you can purchase for. We are in a competitive market. There's a lot of bidding because inventory is low. And so if you have that information up front, then you can shop confidently, right? And pre-approval will also secure your interest rates. And so we can secure your rate for up to 4 months. And depending on, whether you're purchasing a resale or a new construction, if that needs to be reviewed past those days, then you can do that. But this is what it does. It gives you the confidence to go out and shop, right? Within your budget, but also you want to get the best bang for your buck. And so we know that the rates are competitively low right now. So securing that right now or before you start is always recommended. And so the truth is, the approval process is actually a two-step process. You have the pre-approval, which I like to let people know that although we assess all your information and tell you this is what your budget, once it's not firm until the lender, bank, mortgage lender, trust company actually reviews everything and is comfortable with it, right? And so you can purchase here in Canada with as little as 5% of a down payment. And so when you are putting down less than 20%, there's a two-step process. The bank has to approve you, and then the default insurer has to approve you. And so you want to ensure, again, with the pre-approval, we're collecting all of your documentation, and I'm going to go through what that is in the next coming slide. And we make sure that everything is in line with what their expectation is, so that, again, that you are not disappointed, right? They also want to ensure that the property is something that they are comfortable lending on. As believe it or not, when a lender is assessing you, they are not only looking at where you are today, they are looking at, in the event that something happens, are they going to be able to recoup their investment? All right. So they kind of lend proactively, right? So we do assess your credit. We review your assets and your liabilities. Sometimes getting your credit, well, not sometimes, all times, getting your credit reviewed up front. It can identify any issues that may be there that you're unaware of. And so we can deal with it before you actually wait until you found it properly and need to submit. All right. How do the lenders assess your application? Sometimes people don't really understand this part of the process. They just feel, well, I'm working, my credit's good, I have my down payment. They're, as I said to you, mentioned in the last slide, they are lending proactively. They're lending based off of risk, right? If I lend this person this money and they can't afford it, can I get back my money, right? So they're looking at it on a holistic level. All right. So what I've kind of summarized it into what's called the ICE formula, right? Just to keep it a quick acronym so you can always know that your income, your credit, and your equity are the three pillars of your mortgage application process. Equity is also considered your down payment, how much savings you have in the deal. So your income, you got to be working. There's no way around that. Or you have to have some form of consistent documented income. It could be investment income. It could be support income. All of that has to be documented. But if you are working, we need to provide letter of employment coupled with your pay stubs to show that you are working and you're working up to date and your pay is in alignment with what your letter says. T4s, NOAs, so your taxes also will be required to be taken care of. So if you do owe the government any money, that needs to be dealt with, because no matter what, no matter how big their mortgage is, the government always comes first. So they want to ensure that you do not owe the government any money. If you get paid by the hour, we will need 2 years of your income documentation to average your income. Because when you're working by the hour, sometimes people work overtime or they're on casual. Some days they work one week they work less hours than the other, or they may not work at all. So we use an average of the last 2 years in order to use that income to qualify. Business for self, which is a little bit more riskier from the lender's perspective. So they ask for more documentation. They need proof of your business. They need proof of how you're getting your income. So if that's through contract, if that's through direct deposit, if that's through checks, we need all of that supporting documentation to prove your income. Because as business for self, which is very different from working through a company where you're getting paid every 2 weeks, we know that self-employed people, if you don't work, you don't get paid, right? So again, they need a lot more documentation to confirm the validity of your business and the type of income that you're declaring. So again, taxes have to be up to date because the government always takes precedence. All right. Other types of income that is acceptable, as I mentioned earlier, investment income. If you're getting child support, if you have children and you get child's tax, we can use a portion of that income as well. Alimony. And sometimes people purchase properties that also have a rental component in there. And so depending on the property and the legality of the unit, we can also use a portion of that income that can be generated from that property to help you qualify. Credit. This is my favorite topic because credit doesn't only relate to homeownership. Credit is required for just about everything now. And so when the lenders are assessing your credit, there's the system that they use. It's a kind of the unspoken system. They don't really say, oh, well, we're checking off these things. But the 5 C's of credit is what they are using to analyze your application. So collateral, again, your credit, capacity, capital, and character. So I mentioned earlier that, the approval process is 2 stages. So they want to make sure that they're comfortable with you as the applicant, but they also need to be comfortable with the property that they are going to use as security for the loan, right? So is the property that if they need to repossess, that they're able to market and get back their money? Where is it located? Types of property, etc. Your credit, again, I'm going to go in deep, more in depth in credit in the next few slides. Your capacity, your debts, right? So they want to ensure that when you are adding a mortgage to your liabilities, that it's not overextending you, right? So we do look at your credit to ensure that, you're not the type that is living off of credit, that you, of course, are making your payments on time, your balances aren't, maxed out. Those are the things that they assess. Income, which I'm going to talk about in the next slide too. Your capital, talk about in the next slide too. So your down payment. Unfortunately, we don't have the lending capacity where you don't have to have a down payment. You have to have a down payment now. There was years ago where we used to offer 100% financing, but now you definitely have to have your own source of down payment as well. And your character. So overall, they're looking at everything. Does this person look like somebody who can manage more debt? All right, so with the credit, this is a very popular question I get, what is a credit score? What is a credit score? So the goal should always be 680. If you don't have 680, that does not rule you out. But the goal should always be 680. And if you're not at 680, there's always things that I can advise you on to help you get there, right? But the 680 opens the door to the best available products out there. You got to have a minimum of 2, more like 3 years of credit history. So if you are fairly new to the credit world, less than a year, not to say that you can't get a mortgage, but you will have to have more equity. You will have to have a larger down payment because they cannot fully assess your ability to repay debt if you have less than the 2 to 3 years that they're comfortable with. You want to have at least 2 active trades. So that could be 2 credit cards, 2 major credit cards. It could be a personal loan and a credit card. It can be a line of credit and a credit card. It could be a car loan and a credit card, but it has to be a minimum of 2 major ones with a combined limit of $5,000 or more. And of course, showing your good repayment history. But not everybody has that or has had that, and life happens. We understand that. And so they may have had to file for bankruptcy or are currently in a consumer proposal. Both of those does not rule you out from purchasing a property. It's just that the rules are a little bit different. They have higher expectation with respect to rebuilding themselves. One, you have to be out of the bankruptcy, so you've been discharged. Consumer proposal, if you're currently in a consumer proposal, most lenders will not lend to you until you're complete. And again, you would have to start reestablishing your credit. So having 2 trades, having 2 years, and also an explanation as to what happened, because we know life happened, but they still want to know what happened. Also, post bankruptcy or proposal, many of the A-type lenders will require you to have 10% down versus the minimum of 5%. So keep that in mind as well. But if you had a large down payment, 20% or more, we do have access to lenders that would lend to you the date that you get discharged or the day after you get discharged. So again, working with the broker, you do have plenty of options with respect to financing. Some tips for credit. As I said, if you're not at 680, that's okay, but there's always ways to get there. And if you follow at least 2 of these tips, you would definitely be on your way. Paying your bills on time, I think that goes without saying, but we know that sometimes things happen, we forget, especially maybe if it's a small balance, $10 minimum, you may slip up. put the calendar alert in your phone, because those little late payments are what hurt you the most. So I do encourage my clients to pay. Don't wait until the due date. Pay before the due date, so that there's, you give yourself some wiggle room, right? So you build that habit. Keeping your balances low. 30% of the limit is the sweet spot, but 50% should be the maximum goal. What that does, it keeps your utilization keeps utilization low, right? Again, remember I said when lenders are looking at you, they want to ensure that you're not living off of credit. Your lifestyle isn't based off of your credit. So by keeping low balances, it shows that you are responsible with your credit, which would, to them, interprets that you are going to be responsible with your mortgage. Right? What does that look like? If you have a $2,000 credit card, you don't want to carry a balance more than $600 to keep your score as high as possible, $1,000 at the max. All right. Major credit cards are always best. One, they offer the better rates, not the best rates, but the better rates, right? If you do have like store cards, pay them off as soon as possible because they're highly, highly expensive. Be mindful of any unused accounts that you have that have gotten canceled, or that there's a zero balance, but they charge an annual fee. And then if you don't pay attention to that, if you miss that, of course, that will be reported as a late payment. Apply for credit only when you need it. And so I stress this, unless you're working on a strategy to build your credit. If you go to the bank teller and they'd be like, oh, you've been pre-approved for a $10,000 line of credit. If you really don't need it, don't take it. All right. It's kind of like a ploy, right? Yeah, you're great. Show that you have responsibility. That you will extend more credit, but that only makes them more money. Because if you have it, what happens is you tend to use it. And when you use it, you're paying interest on it, right? And so in one of my other workshops, I talk about, how carrying debt is eating away at your ability to build wealth. So only apply for credit when you need it. Avoid closing credit accounts. So the longer you have credit history, the better. Sometimes if you have an account that, you've had it for years and you're not using it, sometimes people just close it. What happens is there's a few components that impact your score, what they use to calculate your score. And so length of credit history is one of those. So the longer you have credit, the better it is for your ultimate score. So if you have old accounts, don't close them if you don't really, really need to. Be careful of co-signing. So I know I mentioned earlier about joint ventures. Again, this is a strategy. So if you are going into a joint venture, then we can assess that. But, co-signing for a car or, even cell phones cause issues on many people's client credit, even though they're not actually responsible for it in terms of paying for it. But if something goes wrong, you are responsible for it, and it will impact you and your eligibility to get a mortgage. So avoid that where all possible. And so this is something I encourage. Know where you stand. Check your credit regularly. The two major bureau institutions here in Canada are Equifax and TransUnion. If you reach out to either one of them, you are entitled to a free report once a year where you just contact them and they can mail it to you. Or if you're like me and don't have patience, you can go online and get it immediately. There would be a cost for it through them if you get the score. But there's also a lot of other companies that have recently popped up that will allow you to access the same information for free of cost. So we have Borrowwell that pulls the information from Equifax. You can sign up for it. It is secure. They are giving you information that may not be 100% current. But if you're just keeping check on, your monthly reporting, make sure your balances, make sure there's no fraudulent activity, it definitely serves that need. Credit Karma pulls the information from TransUnion. It too is free. You just sign up. And what I like about these things is that if somebody pulls your credit, you get an email to make sure that, they let you know somebody's pulled your credit. So it allows you to stay on top of any changes that happens to your credit that you may not have done yourself. All right. And they're free. All right. And so the E in the ICE formula, equity, i.e. your down payment. Again, you have to come to the table with some form of investment. Minimum, again, is 5% of whatever you are qualified for, up to 500,000. Any purchases over 500,000, it'll be 5% of the first 500 and 10% of the difference. So if you're purchasing a property of 600,000, it'll be 25,000 plus 10,000, so 35,000 as your minimum required down payment, right? How do the banks want to see this? It has to be through a traditional savings means, whether that's a savings account, a checking account, investment account, something that there is a paper trail, all right? And we will have to provide the lender with proof of this, 90-day history of where this money is coming from, because they do not like to see strange amounts of large deposits or anything like that. They like to see an accumulation of funds, right? Non-traditional savings strategies are not acceptable from the lenders, i.e. PODNA or SUSU. Keeping money under the mattress doesn't work with the lenders. So if that is a way that you are saving, you would definitely still have to have a strategy in where you're, strategically depositing it into your account so it doesn't look fishy to the lender. All right. You can accept gifts from your immediate family member meaning mom, dad, brother, sister. Anything outside of that may not be accepted. We do have some home buyers plan. So the RRSP home buyers plan here in Canada, where if you have saved in your RRSPs, and what your RRSP is your registered retirement savings plan for, when you don't have to work anymore. You can borrow from that to purchase a home as a first-time home buyer. And so as a first-time home buyer, you can withdraw up to $35,000 if you have that amount saved. If you don't, you can also take out, there's RRSP loans that you can take to deposit it in your RRSPs, and then later pull it out for this program. If you are a couple, that's up to $70,000. All right. And so that program allows you to pull from yourself, but will have to be repaid starting 2 years after your closing date. All right. There is a program that is out there that I was just yesterday speaking to a client about that I talk about, but I don't necessarily like, is the first-time home buyer incentive program. And so what that is the government had launched this program a couple years back, where it's called a shared equity program, meaning you have to have your 5% and they will match your 5% if you are purchasing a resale home, or they will match your 5% with a 10% if you're purchasing a new construction. And so what the objective of this program is to allow you to purchase a home a lot sooner, right? With giving you the ability to have smaller monthly payments. But at the end of that, once you decided that you wanted to sell, or if you're keeping the home, you will have to repay the government their portion, and that portion will look like 5% of the appreciated value of the property or 10% of the appreciated value. So it's available, but we can talk about that later. There's also some other affordable homeownership programs in some of the smaller counties where they will give you up to the 5 or 10%. They're not as popular as they were before, and it's kind of where the shared equity program derived from. But we have to search for them in the little counties that they are available. I think the last one that I knew of was up in Orange County, which you're in Dufferin, right, Alethia? I think it's up.
Yes, we're in Dufferin County. I know we do have an affordable homeownership program here, but I don't know the details of it.
Right. So it's similar to the incentive program. However, they will give you the 5%. You don't have to come up with your own. You do have to buy a home in the area. They do have some income restrictions as well as purchase price restrictions, but it is an opportunity for you to get in wherever you can fit in. Rent to own. Again, another program that I'm not very proactively promoting. It is an option, but it's ideally for people who have savings already, but need time to repair their credit. The programs can be very expensive, And a lot of the lenders will not accept the buyout of the program. So we have to be very cautious when you are entering into a rent-to-own agreement. Please be sure that you're speaking with a professional who has experience and can provide proof that if you do enter into the program, that you will be able to get a mortgage to get out of it. All right. Newcomer to Canada. This is also a program where you can purchase, if you're new to the country, within 2 years. Some of the main requirements are tweaked a little bit to accommodate you. If you're here for, less than a year, less than 2 years, you may not have enough established credit. So there are exceptions that they will make and supplement those requirements with other ones. So if you're new to Canada, you can definitely still purchase a property. All right. And so we're almost at the end. And so who's on your team? So as you know, purchasing real estate will most likely be the largest purchase you'll ever make in your lifetime. And so I can't stress how important it is to have the right team working with you and making sure that through the process that they are looking out for your best interest and making sure that you're meeting your financial goals as well as your family goals, right? And so who would you need on your team? Of course, a mortgage broker. That would be me. As we talked about, knowing the numbers before you get started, all right, that is the hub. That is, if you haven't done the numbers, then you have no business looking for a property. A real estate agent. Real estate agents can primarily help you with resale properties, but they too can help you with new construction. So having a real estate agent, giving them all the particulars with what you need in terms of the property and location, and they have access to information that you can't readily find on MLS.ca. If you just hit Google, they have more accurate and detailed information with respect to what's available on the market. Property inspector, whatever property you're purchasing, you always want to have a third party come in to ensure that they are looking for the things that you can't see at eye level, right? Foundation, roof, electricity, like things like that. So you'll definitely want to have a property inspector review that. And that can be referred to typically through a real estate agent. A real estate lawyer, all transactions will be required to be finalized through a real estate lawyer. And so they handle the exchanging of the monies as well as the legalities, title searches, registration, and all of that good stuff. And something that most people don't talk about is a financial coach or an advisor. As I said before, investing in real estate is really just one of the pillars in creating your family generational wealth. And so you got to make sure you know all of your money, all of your numbers, and making sure that the investment is going to help you and not hurt you, right? So looking at your full financial house is definitely recommended. And most of the services offered by these are free. All right. And so my final thought is don't wait to buy real estate and wait. All right. We live in a very, very prime market. And I truly believe that you can't lose as long as you have the right team that is advising you based on where you are and what you need. And you really, really can't lose. Just make sure you're buying something that works for you financially and holistically. And you can reap the fruits. And so I just wanted to make an offer. As I mentioned earlier, credit is something that is very near and dear to my heart. We need credit for everything. We need credit for cell phones. We need credit for utilities. Many people need credit for your job. So I am offering a 30-minute credit consultation to anyone who just has questions. You can go to this URL, click and find fill out the form, and I will schedule an appointment with you to discuss your current credit situation.
Amazing.
Thank you.
Wonderful. Sorry, go ahead.
No, I said that's it. And last one. Stay connected. I am on all social media platforms, Facebook, and Twitter. Facebook, Instagram, and Twitter. Instagram is my playground. That's where you'll find me most. But you can find me at Siobhan Bent or Mortgages for Moms. And so thank you, Alethia.
Amazing. Oh my gosh, I took away so much information from tonight's session. Thank you. I know some individuals had their hands raised. I believe, Sheena, you had a question when we were at about the credit section. Mm-hmm. Did you want to unmute yourself and ask your question?
I was really excited when I heard, give me a second. This is how real I'm about to get right now with everyone.
Mm-hmm.
I'm cooking. I have family responsibilities. Hi.
Hi.
I really got excited as I was listening because my hand was raised not knowing. I had a separate question, but it's really good to hear. So there are two questions that came out of your discussion. And thank you so very much for speaking to that. The first would be, it's my understanding that anybody who does a credit check, it's going to ding their credit. Is that true?
It depends on who is pulling it. So if I pull it, it's considered a ding, a hard hit. If you pull it, it's considered a soft hit. So it's not going to impact your credit.
So what's the difference between a soft and a hard hit to your credit reporting?
With a hard hit, that means you will lose credit points. So it'll impact your credit score.
And the second question would be, I know that you spoke around conversations with individuals who might be first-time homeowners. But what about individuals who are already homeowners, but thinking about doing investment property? What does that look like in respect to down payment, or what does that look like in respect to what next steps are?
All right, so it depends on where the down payment's coming from. Many existing homeowners will leverage the equity that's in their home to purchase the next property. And so you would have to determine, are you planning to leverage the equity and live in the home, or leverage the equity and buy another principal home? And
I guess my last question to that, thank you so very much, would be, what's the difference? What are the pros and cons?
If you are leveraging your equity to buy a home to live in, then you can purchase that next home with as little as 5%. If you are purchasing it strictly for investment purchases, it has to be 20%.
Interesting. I didn't know that, because I kid you not, a lot of the different brokerages that are coming my way are speaking to 5%, but I didn't know anything about 20%.
Yeah, as long as it's a principal residence, as long as you plan to live there, you can purchase with 5%.
Thank you kindly. I appreciate that. Thank you.
You're welcome.
So it sounds like you have a great deal of questions, Sheena. I would encourage you to reach out to Siobhan using the link. I'll actually send you the link, and you can have that 30-minute consult session and take it from there.
Thank you kindly. I'm a person who loves to talk, so I can continue right now, but
no worries. We only have 6 minutes left. We want to open the floor to others, so thank you. Are there any other questions from the chat? Okay, one of the questions that Sheena actually touched on was the difference between, leveraging the equity from your home versus taking a second mortgage. And is there a difference?
That's basically the same thing.
Oh, okay.
So you are securing a loan based off of the equity. So a second mortgage would be leaving your existing mortgage in place and then taking out another mortgage for the equity and putting it in second place. So you then have two mortgage payments. The other way is just to leverage is you're going to discharge the existing mortgage and increase it to take out the equity, but still only have one mortgage.
Okay, perfect. And you touched on joint ventures, and especially, when you're thinking about, building that generational wealth. Can you elaborate a little bit more on, how that would work and really what does that entail? So you touched on the fact that it could be, a couple people, multiple people coming together. Can you just give a little bit more detail?
Well, first, any persons who are thinking about that, just first seek legal counsel, right? Because you got to have everything contractually agreed upon. But what that looks like in terms of purchasing, it's really pooling your resources. So that's pooling your savings, pooling your income to qualify for the loan, and pooling your credit, right? So again, everybody's going to be responsible for the loan if they're all on title, but it's really giving yourself the ability to access more property, right? The more income that you have, the more savings that you have, the more options that you have with respect to properties.
Okay. And would there be any, I guess, penalties or restrictions, or would it be frowned on when you do that for a home versus, let's say, a commercial property?
With a commercial, it's a little bit different.
Okay.
Down payment requirements are a lot higher, and the process is a lot more complex, but it's not impossible. And typically for a commercial, it wouldn't be individuals purchasing. It would probably be, they would come together and start a corporation or something of that sort.
Okay. Great information.
Thank you.
I do have a question. It's Steve, Alethia, if you don't mind. I know that we're wrapping up. First of all, excellent presentation. I wish I had this information when I was younger and I wouldn't have made the missteps regarding my credit. So the fact that you were providing it in such great detail, I think is fantastic. And by the way, the reference to the partner brought back childhood memories of, people knocking on my door and handing my mom envelopes. And I was wondering what the heck is going on here. But I came to learn that it was partner and nothing else. But as a young child, you're wondering what is going on here? People coming by all sorts of the day and dropping off money in an envelope. But partner still works. People are still using it. But here's my question, just to follow up on what Sheena was saying about having a property and leveraging it for a purchase of another investment. And there was talk about the home equity line of credit and maybe some other options. And so my question to you specifically is, what would you recommend between the two options? One, which is the home equity line of credit, or refinancing in order to get that property?
So if you have a mortgage and you're looking for a home equity line of credit, that is still considered a refinance because you're switching product. You have to discharge what you have to get something new, right?
Okay.
If you are getting, I think what Alethia was asking about earlier was a second mortgage, which is a second security. So the comparison would really be cost. Which one is going to make sense? For some people, depending on the mortgage that they have or when they had it, at the time when they now want to leverage the equity, the cost to break that may be extremely high. So it makes better sense to use a second mortgage to access the equity for a short period of time in order to purchase that next property. But it would still be considered a refinance if you're switching from a fixed mortgage to a line of credit.
Okay, and just to follow up on that point very quickly. So in my situation, for example, you're right I'd be breaking my mortgage or discharging that for the refinance. But what if it comes to a situation where now I'm renewing? So I'm at the point of renewing, so I wouldn't have to discharge, right?
If you're taking a new product, essentially you still are, but there will be penalties to do it.
I see. Okay. All right. Thank you.
You're welcome.
Awesome. This takes us to time. Do we have any other questions from the audience?
One more quick question. It's Ian speaking. Just with respect to the second property, if the second property is purchased as a seasonal residence for personal use for a portion of the year, and then probably for renting or Airbnb for another portion for the remainder of the year, would it still be subject to the 20% down payment that you mentioned earlier?
No, if you're purchasing it as a second home, you can purchase with 5%, but you'd have to qualify for both, and there you wouldn't be able to use any of the income potential to help qualify you.
Okay. Thanks for clarifying that.
You're welcome.
Great question. I'm actually going to ask you one last question. And given the market right now, a lot of parents, myself included, are worried about the future for their children and their opportunity to purchase a property. So if we wanted to take the leap and invest for them, essentially, are there pros and cons versus purchasing, let's say, a condo in for example, the GTA core versus purchasing a house in a remote location and having it sitting there as a rental income until children are, of age and ready to move out on their own? Are there pros and cons?
My opinion wouldn't be there's no real pros and cons other than you being responsible for tenants, the upkeep of the property. No, it would really be about the lifestyle and where you can get someone to rent to cover the expenses. So anything that you're going to purchase, in my opinion, should be cash flowing from day one. Mm-hmm. So if you do purchase a property in the remote, you have to also factor, is it going to be, how easy is it for you to rent it? Are you going to be able to get a covering to cover the costs, the expenses of it? You have to factor in vacancy, whereas, in Toronto, condos are a lot easier. The turnaround could be a lot quicker. So I would say, my personal opinion, no pros or cons really. It's just your ability to manage and cover if there's any shortfall.
Perfect. That is fantastic. Thank you. Can you do me one favor and put your screen up again for with your contact details?
I can.
And for those of you still on the call, please make sure you drop in the comment section how well you thought tonight's session was. Your comments, your feedback, all of that goes a long way in helping us to make sure that we continue with these programs. And of course, we'll be able to share the feedback with Siobhan and letting her know how well received our presentation was. So on the screen, you have all of Siobhan's contact information. Feel free to jot them down. And of course, you can always reach out to me and I'll forward them over to you. Our next session is scheduled for the first Tuesday in December, so stay tuned for information for that. And of course, please don't forget to visit the Dufferin County Canadian Black Association website. Make sure you sign up to be a member if you have not already done so. And last but not least, visit our merchandise store where you can purchase your very own copy of the DCCBA Inspire t-shirts. So hopefully you can see my screen. The purchase of the t-shirts, of course, goes towards funding our scholarship programs and, of course, making sure that we are able to continue to provide these amazing programs for the community. So thank you very much, everyone, for coming out. Thank you so much, Siobhan, for your expertise, and we will definitely be in touch after tonight's session. Awesome. Thank you, everyone.
Have a great evening, everyone.